What if I told you CRA can reassess a tax return from 15 years ago, today, with no deadline at all? Forget the number you've heard about 3 years being the limit. If CRA decides you were merely careless, Subsection 152(4) CRA is a of the Income Tax Act lets it reopen your file at any time and turn a forgotten $2,000 into a bill that never expires. I read the fine print so you don't have to. Millions of Canadians assume that once 3 years pass, their old returns are locked away for good, and that single assumption quietly leaves them exposed for 6, 10, sometimes an unlimited number of years. So today I'll show you 3 moves: verify your reassessment clock, check your foreign property risk, and audit-proof your returns against a charge of carelessness. Here's the number everyone repeats: 3 years. For most individuals, CRA has 3 years from the date printed on your notice of assessment, not your filing date, to reassess a return under Income Tax Act Subsection 152(4), Rosen tax law. But here's the part nobody tells you. 3 years is only the floor, and the Act is full of trapdoors that drop right through it. 3 moves: verify your clock, check your foreign property, and audit-proof against carelessness. Each takes under 20 minutes and costs nothing. The first trap is where the clock even starts. That 3-year window runs from the date on your notice of assessment, not the day you filed. So a 2022 return assessed on May 1st, 2023 stays open until April 30th, 2026. Taxpayer law. And Subsection 152(4) hides several extensions that quietly stretch that same window to 6 or even 7 years, depending on what's on your return. So the return you thought closed at 3 years is actually open far longer. For foreign property, loss, carrybacks, and non-resident dealings, CRA gets 6 years for individuals and 7 for larger corporations, Rosen tax law. And if you hold more than $100,000 in foreign property and your T1135 form is late, wrong, or missing, CRA can reassess that year for a full 6 years instead of 3, Rosen tax law. Now the second bigger trap, the one with no ceiling at all. Under subparagraph 152 or 4 AA, of the Income Tax Act, if CRA can show a misrepresentation from carelessness, neglect, willful default, or fraud, it may reassess the return at any time. No statute-barred protection whatsoever. Taxpayer law. And notice that word, carelessness. You don't need to have cheated. A sloppy mistake is enough to open the year forever. Here's what inaction actually costs. Say you assume 3 years means safe, so you toss your records and forget a small freelance slip. Then in 2036, CRA reassesses your 2020 return and calls it careless. On $25,000 of missed income at a 30% rate, that's $7,500 in tax, plus 16 years of daily compound interest, plus gross negligence penalties reaching 50% of the understated tax, Carelessness tax law, a total well over $20,000. So let's kill the myth directly. The belief is, once 3 years pass since my notice of assessment, that year is closed and CRA can't touch it. The fact, straight from subsection 152(4), 3 years is only the normal window. It's 6 to 7 years for foreign property and carrybacks, and no limit at all for careless misrepresentation, Rosen tax law. Put the two costs side by side. Foreign property years can stay open for 6 years when a T1135 is missed, Rosen tax law. And gross negligence penalties can reach 50% of the tax you understated, Carelessness tax law. Combine those extended windows with daily compounding interest and a small forgotten error, snowballs into a 5-figure bill. Let me make this real. Meet Sarah. She's 42, a mid-level marketing manager earning $95,000 in salary, plus about $8,000 in freelance work she sometimes miscategorizes. She's got an RRSP, a TFSA, and a non-registered account holding $130,000 in US and international ETFs. That last one matters more than she realizes. Discovery 1 hit her first. 6 years. That's how long her 2020 return actually stays open. As an individual, her normal window is 3 years from her notice of assessment date, taxpayer law. But because her foreign ETFs top $100,000, a missed or wrong T1135 extends the window on that year to 6, Rosen tax law. Her 2020 return, assessed July 15, 2021, is exposed until July 2020, twice as long as she assumed. Discovery 2 was the scary one, over $1,000 in eventual liability per forgotten slip. Sarah had occasionally missed reporting $2,000 to $3,000 of freelance income. Under Subsection 152(4)(a)(i), if CRA calls that carelessness, it can reopen those years at any time, taxpayer law, turning a missed $2,000 into $600 in tax plus years of interest and possible penalties, easily over $1,000 each. Discovery 3 is the counterintuitive one. Her own good intentions could backfire. In 2026, Sarah realizes she overpaid tax on $5,000 of investment income back in 2017. CRA allows taxpayer-initiated reassessments up to 10 calendar years after the year end. CRA. So she can chase a $1,500 refund, but filing that request lets CRA reopen the entire 2017 year, including any income she forgot to report. Add it all up across a career. Modeling repeated small underreports plus one T1135 miss. Treated as carelessness, Sarah's lifetime exposure, tax, interest, and penalties combined, plausibly reaches around $40,000, author's estimate, using statutory percentages. This is general information, not personal advice, and Sarah is illustrative, but the mechanics are straight out of the act. So could this be you? Sign 1. You've never actually checked the assessment date printed on your notices of assessment. Sign 2. You don't know whether your foreign investments ever crossed $100,000 in a year. And sign 3. You haven't confirmed every slip made it onto your returns. If any of those ring true, the next 3 moves are for you. Here's the good news. You can close most of this exposure yourself, for free, in an afternoon. These 3 moves map exactly where you stand. Fix the foreign property risk that quietly doubles your window and make any honest mistake defensible so CRA can't call it careless. Do them in order, and you turn an open-ended threat into a known, manageable set of dates. Move 1. Verify your reassessment clock year by year. Log into CRA. My Account, open your tax returns, and find the date printed on each original notice of assessment. Count 3 years forward. That's when the normal window closes. Then flag any year with foreign property, lost carrybacks, or non-resident items, because those run 6 years or more, Rosen tax law. So concretely, log into CRA My Account and open the tax return section for each recent year. Note the assessment date, count 3 years forward, and mark foreign or carryback years as 6 instead. When you're done, you'll know the exact calendar date each open year finally closes. Move 2. Check your foreign property and T1135 risk. This is the one that quietly doubles your window. For each year, add up the maximum cost of your specified foreign property. US and international ETFs count. If any year topped $100,000, confirm a correct T1135 was actually filed, because a missed one extends CRA's reach on that year to 6 years, Rosen tax law. Step by step, pull your brokerage statements and total the foreign property cost held in each year. In CRA My Account, check whether a T1135 was filed for any year that crossed $100,000. If one was missed and the year's still open, talk to a tax pro about the voluntary disclosures program before CRA finds it. Before I get to the last move, which is the most counterintuitive part of all this because it's the one that decides whether your window is 3 years or forever, this is the one to actually do. Move 3. Audit-Proof against carelessness. Pull your slips for the last 3 to 6 years and compare them line by line with what you filed. Then correct any gap yourself while the year is still open. So, gather every T4, T5, T3, and brokerage summary for the last 3 to 6 years, compare each line against your filed return, and file a T1 adjustment for anything you missed. Correcting it yourself makes it far harder for CRA to call it careless and reassess with no limit. If breakdowns like this are useful, subscribe. The next one's already coming. Why does this matter right now? Because the window has only ever widened. In 1994, CRA introduced the T1135 foreign property form, creating a brand new trigger for extended reassessment, Rosen tax law. Through the 2000s and 2010s, amendments to Subsection 152(4) clarified 6 and 7 year windows for losses, credits, and non-resident dealings. And case law keeps reinforcing that carelessness alone allows reassessment at any time. The reach only grows. Once you've acted, confirm it worked. You should see an assessment date and open or close status for every recent year in My Account. Check that a matching T1135 exists for any year your foreign property topped $100,000. And if you filed a T1 adjustment, expect a reassessment notice confirming the correction landed. Everything here comes from the Income Tax Act, published CRA guidance and tax law analyses of Subsection 152(4). I've linked the specific sources below so you can read the exact provisions yourself. This is general information, not personal tax advice. So now you know the real limits, 3 years, 6 years, or no limit at all, brace, and the 3 free moves that close your exposure. Next, I'm covering the Voluntary Disclosures Program, how to fix old returns and dodge penalties before CRA ever reaches back. That one could save you thousands if you've got an old mistake sitting out there. If you want to catch it, subscribe now so you don't miss it when it drops.